Are VUL and investment-linked insurance policies good? One of the most popular insurance and investment policies today are called the VULs. That stands for Variable Unit Linked, and sometimes it's called investment-linked policies. And chances are, if you've ever met with a financial advisor, well, you would have been offered to avail of a financial product like this, because these are the best-selling products of insurance companies. But just because they are best-selling products, of course, that doesn't mean they are good, nor do they mean that they're perfect for everyone. So our goal in this episode is to help you understand VULs and investment-linked products so you can decide on your own whether they will be a good fit for you and your financial goals. But before we start, please allow, what is a VUL or an investment-linked product? Take note, they're the same thing. So a VUL is basically an insurance policy attached to an investment. So it's two things in one, an insurance policy with an investment component. The primary benefit of products like these is that no matter what happens, you get to avail of the benefit. For example, in the event of untimely death, you're going to be covered by the insurance policy, meaning your beneficiaries will receive something. But let's say you live up to 100 years old, so you don't use the insurance. But hey, your investment would have grown. So technically, no matter what happens, whether you die early or you live too long, the VUL has you covered. Sounds good, right? So does this mean the VUL is a good investment product? Well, keep watching as we go deeper into how it works. How does the VUL work? There are currently two kinds of VULs. First, you have the single pay VUL and then the regular pay VUL. What's the difference between the two? We'll explain each one. Single pay VUL works just like it sounds. You pay one time, as in single pay. Now, the insurance component of this product works with the following formula. You are covered for A, 125% of your investment, or B, your investment value, whichever is higher. So let's go into a few examples here. Let's say you paid 100,000 pesos for your VUL, for your single pay VUL. You will be covered for up to 125%, which is 125,000 pesos. Now, if you paid 500,000 pesos, you're covered for up to 625,000 pesos. So the 125% is the absolute minimum that you will receive in the event of untimely death. So ito yung insurance component. How about the investment portion? When getting a VUL, you have a choice on where you would like to invest your money. So your money will have the potential to grow over the years. So if your 100,000 turns into 200,000 after a couple of years, in case you pass away, your beneficiaries will receive 200,000 pesos, not just 125,000. Okay? Because it's whichever is higher. Again, the formula is A, 125% of your investment, or B, your current investment value, whichever is higher. So that's the way the single pay VUL works. Now let's go into the other kind of VUL, the regular pay VUL. Here, you no longer pay one time, but regularly. Whether that's quarterly, semi-annually, or yearly, ito na yung parang hulugan. Now, where does your money go? With a regular pay VUL, during the first several years, your payments are going to the insurance portion. It is only after 3 to 5 years that the investment component gets built up. So here is a sample policy to show you how this works. For a 1 million peso insurance coverage, the annual payment for a regular pay VUL will be about 28,000 pesos per year. And of course, this will vary depending on your age and your health and other factors. Now, let's just say it's 28,000 pesos per year. On the first year, majority of the 28,000 will go to insurance payments. Meaning, of the 28,000 pesos you paid, about 25,000 pesos will be spent on insurance, while only 3,000 pesos will go to the investment portion. And take note, whatever is spent on the insurance portion, you can no longer withdraw. Let me repeat that. Out of the 28,000 pesos you paid, you can only withdraw 3,000 pesos because the 25,000 pesos went to the insurance component. On your second year and third year, this continues. So let's say after paying 28,000 every year for 3 years for a total of 84,000 pesos, it's likely that you'll only be able to withdraw somewhere around 14,000 pesos. The rest of the money was spent on insurance. It is only on the fourth and fifth year onwards where your money will actually go to the investment component. So, what really happens with the regular pay VUL is that you're paying for your insurance first, then investing later. It's important to know that difference. So now that you already know what VULs are and the difference between single pay and regular pay VUL, let's answer the question, are VULs good? Since VULs are both insurance and investment products, we will evaluate them as both an insurance product and as an investment product. So first, let's talk about the insurance side. Are VULs good insurance products? In this table, you can see where the VUL ranks compared to its alternatives. So, the absolute worst thing you could be doing is having no insurance coverage at all. Because if something bad happens to you, you might end up being a burden to the people you care about. And this is really bad. Now, a little better than that can be considered pwede na is the regular pay VUL. They are ranked this way because as you saw in our earlier examples, majority of your money is going into the insurance component. And take note, that's very, very expensive insurance. Now, even better than the regular pay VUL are whole life insurance and single pay VULs. Whole life insurance is another kind of insurance which we won't discuss here since it's a whole other topic. Just be aware that you have better options for insurance. Also, under this category is the single pay VUL. Now let's go to the best option. The best option for insurance is getting what's called term insurance. And this is the simplest and cheapest, most cost-effective form of insurance. Just to illustrate the cost-effectiveness of term insurance, a 30-year-old can get a 1 million peso coverage for as little as 5,000 pesos. While when compared to the regular pay VUL, the same coverage will cost you 25,000 pesos. So, alongside this category of what's best when it comes to insurance is also the strategic use of single pay VULs for estate planning purposes. Again, we won't go deeper into this, but you can ask an insurance agent for more information about it. So in terms of insurance, where does VUL rank? The regular pay VUL is good, pwede na. The single pay VULs are better options. So that's the insurance evaluation. Now, let's evaluate VULs based on their investment ability. Here is our ranking. Really bad is having no savings at all. Bad is putting your money in time deposits and putting your money under the bed. It's not gaining any interest, plus it can easily be stolen. Now, also bad is the first 5 years of regular pay VULs. Regular pay VULs are bad as an investment because at the start, all your money is going into that very expensive insurance premium. So you think you're investing, but actually you're just buying very expensive insurance. On the good investments, here we have mutual funds, UITFs, and single pay VULs. Then, the best is having investments that are perfectly aligned to your unique financial goals. Whether this is in stocks, bonds, real estate, commodities, the perfect investment really is if it helps you in achieving your goals. So, let's go back to the question. Are VULs good? Regular pay VULs are pwede na in terms of insurance, but they are bad investments. While single pay VULs are good insurance and investment products. Now, take note, VULs in general, they aren't the worst, but they also aren't the best. So if you want to make the most out of your hard-earned money, the next best action would be to keep learning and educating yourself about the different financial products available. Because perfect investments for everyone don't exist, but there are investments